Massive opportunity ahead to make money for Americans. We will talk a little bit about why that is, why Europeans have to sit on the side on this one. We will talk about the discount to NAV, and we will also talk about dividend yield going forward. So all this exemplifying using triple point venture growth in this case. So a business development company. Why is it the case that we can't invest as Europeans? Well, it's due to regulations. We can't invest in ICANN enterprises. We can't invest in business development companies like TPVG in this case. This creates selling pressure on the stock. On European platforms, you're only allowed to sell. So this one is for the 1/3 of you guys who are watching from America only. We can see that the stock here, Triple Point Venture Growth, has been under some serious pressure lately. This is due to the increase that we saw in interest rates. This creates a less profitable environment for them to operate in, as the spread between the cost to lend and how much they earn in terms of the yield that they lend out the money to other companies in return for, that difference is shrinking. So in a low interest environment, when capital is cheap, they can take on cheap debt and then just take that money and lend it out more expensively. So companies, BDC companies like Triple Point Venture here, they're doing the revolving credit facilities that we hear about in earnings calls when we watch those together, and they're doing some other private lending as well to private equity companies. So that's the situation, that's the area where BDCs operate, one that banks don't partake in due to higher risk. So we're seeing BDCs, we're seeing shadow banks, we're seeing private credit, and everything is being judged very pessimistically now with, for example, Blue Owl, BlackRock funds freezing withdrawals. They only had 5% withdrawal of total assets in some cases, and having to do fire sales to get liquidity to pay investors who want to exit this type of fund. And I think that all investments going forward will be judged by the same metrics, and investors will just sell off more, as we've already seen, without really taking into account if the loan portfolio is good or not. And this will create some interesting opportunities for Americans, to be sure. So we can see market cap here of 212 million right now. So that's where they are trading at. And if we take a look at the balance sheet, we can see that the total amount of assets is a lot higher than that as of right now. And the invested capital here, roughly 800 million in this case, that's being lent out. Of course, some of this is debt and some of it is just pure equity in this case. But if we do some quick calculations to just see what the discount is to the net asset value in this case, we can see that we get a little more than a 40% discount on net asset value in this case. And this calculation lines up nicely just when I do a quick overlook of the balance sheet, comparing it to the market cap, remember 200 million, and then we can take a quick look at where we see the common stock equity, in this case quite a lot higher, 353 million, comparing that to the a lot cheaper market cap where the stock is actually trading in the market. So this is how the market is valuing private credit right now, these type of loans. And we see with private funds, with funds that do this private credit, they don't get valued by the market as commonly, so they have higher priced right now, and the problems are starting to show now that investors want their money out. But subject to market risk, we see this massive discount, and it's not completely unfair that this company is trading so cheap right now. I think it's very likely that stock price will continue to go lower as we see the sale of private credit just starting. If we take a quick look at dividend history, by the way, the yield here if we take a look at payout ratio, below 90% on a historic ratio, but on a forward-looking metric, it's slightly above 100%. So perhaps we see another dividend cut in this case. We can take a quick look here. We can see that historically, all right, 36 cents a share a quarter, even a special dividend here once, 37, 40 cents a quarter. Wow, looking very good. And then we see a dividend cut here in 2024, back to 30 cents a quarter. And then we see another dividend cut back to 23 cents a quarter here in 2025. And with the current payout ratio, this might perhaps not be the end of it. We might see another dividend cut very, very soon if we look at forward-looking metrics. And, you know, with the dividend of 17.46%, yes, that's not unreasonable to expect. The market is pricing in this, and I think we will see more pessimism in the sector before we see a turnaround. And at some point you just look at the discount to NAV and you think, how much cheaper can it get? It is what it is. Eventually the discount is just gonna be too big on some business development companies where you think, all right, how can I possibly mess up here? Of course, you can always have bankruptcies, but if you follow along on the earnings calls and you gauge the loans, the loan portfolio, you hear the delinquencies, you know, how many of these are defaulting, what's the confidence level of management. I think it will be very, very possible to find a few gems for American investors in the business development sector. So as of right now, big pessimism being reflected. We see this high yield, we see this discount to NAV, and we've seen historical selling pressure right now as well with European investors who traditionally, a lot of us, we put our money into America because you guys protect property rights and it's less regulation and it's just a safe place to park the money. We've seen this throughout history. We see a lot of issues in other parts of the world, to say the least, but America, very good place to park capital. And in this case, high yield, wow, high yield, big opportunity going forward. At least from Europe's side, we can still follow along on the REITs, where we're starting to see recovery. It's been a very, very good start to 2026 for a lot of REITs, and as well as good end to 2025. But I think that in terms of a next good opportunity for risk to reward, I think that the recovery in BDCs, once the market, you know, is done being pessimistic in this sector, will be these BDCs. So great opportunity to come for sure, especially once we get those lower rates and we get the better spread on the lending portfolio. That's been it for this video, and as always, hope you guys make a ton of money, whatever investments you decide to make. Take care now, bye bye.